Hi, I'm Peter Rose, founder of Longwood Currency Trading. Is Forex the best market to trade as retail traders? Is that the best market? And there are three reasons I'll go over in this video today. Hopefully a short video because I want to get back to my desk. I just got a new computer, so I got to get that set up. As a former software engineer, I'm still doing programming, and so there are probably 40 different apps and programs and what they call jar files and stuff that you have to download, plus a development platform. It just becomes more complicated than just plugging a new box in and running with it. So I'm hoping to do that today as we move forward into the new year, 2026. This is early January 2026. As you can see, it's a bright sunny day, and some of you have asked, what's that thing in the background? Let me see if I can move the screen up to the window a little bit more. Right to that center square there. You see that thing in the trees? Yep. That is a treehouse. Who has a treehouse in their yard? Anyway, what makes the Forex market popular that would attract us to trade it? But if you don't understand the underlying market itself, then how are you to develop any confidence that that's the market that you want to invest your time in order to trade? And what are the opportunities that are available to you? Well, let's talk a little bit about opportunities first, and rather than getting into the three things as to why the Forex market is the best market. Opportunity would be probably one of them, but I don't put it on the list. It's the opportunity that attracts us, right? Oh, I could take a small amount of money, and I don't mean $500. I mean, if you're going to invest in stocks and trade stocks, you need $25,000 just to trade in the American stock market, because you're what's called a pattern day trader, and you have to have $25,000 in your account if you're going to do trading. So that's a small account. So in Forex trading, $25,000, $30,000 is considered a small account. And yet so many of the people are involved in this stuff, trading $1,000 accounts and $500 accounts, because that's all they can afford. Forex makes it possible to do that by trading mini lots and micro lots, but you're really not learning good trading practice because you're trying to take $100 and make it $500. And that's a wonderful thing from a percentage standpoint, but you're not going to be able to take $100,000 and move that to $500,000 in 4 months, okay? So the proportions are the same, but the realism of it is not. So you have to determine what that opportunity for you is. If you're trading at reasonable leverage with a really good risk management plan, then you can make at least 20% on your money, I would think. Because if you can't make 20% against your risk, you absolutely don't know what you're doing, and you're just looking for a pie-in-the-sky run. 20% is a great number. Try to get 20% out of your bank for a savings account. Try to get 20% out of the stock market. But you can lose all that really fast, too. You could lose all your money in stocks. Take you a little bit longer, but in Forex, you could lose it all in 15 minutes. Well, okay, so that's just the way that goes. But the opportunity is there if you don't trade at large leverage and if you have good risk management. Then the opportunity opens itself up to you for 20, 40, 60, 100% a year. That sounds fanciful and like I'm breaking SEC rules to say that. I'm not saying you could do it. I'm not saying I can do it. I'm saying that's what the opportunity is. There's an opportunity to go to the moon as an astronaut. Well, you have to do all this work and study in order to qualify. You're going to have to do the same thing. But the opportunity is there. And I would tell you that that opportunity is very, very easy to obtain the skills for. So is Forex the best market to trade? And so let's take a look at the three three things that I feel are the strongest, and they are purpose, liquidity, and the safety. So let's take each one of those and look at them. The first, purpose. The purpose of the Forex market is to facilitate international trade. Now, the only way that two countries can trade between each other is to exchange currencies. There has to be a currency conversion. If I'm in England and I want to buy American auto parts, then I've got to sell pounds and buy dollars because the United States isn't going to take pounds, they're going to take dollars. The euro was created to eliminate all of those currency issues between all the countries. How'd that work out? Well, if you remember Brexit, when the currency market of the euros and the pounds and the dollar and all that's it created total havoc. When you look at a country, the thing that makes them viable is their currency and how they want to use it. They don't want somebody telling them what their fiscal policy should be. The United States has a Fed board that determines interest rate policy. Would we want Scandinavian countries to be telling us what our interest rate policy is? No. So it's never going to get to a point where there's going to be a universal currency until maybe we've populated a dozen different planets out there, and then each planet will have a currency. That's barring the fact we don't blow our asses off and before that. But I don't think it's feasible that in the next 50 years that there's going to be a universal currency. You know, there's some that are trying to get an Eastern Bloc group of countries together to form their currency thing. They're going to run into the same problem that the euro did. And the euro just made the currency markets better because now you have a larger market to trade with. So the U.S. can trade with all of those countries by just trading the euro. So in the big picture of the currency market at $7.6 trillion a day, 47% of the volume of that $7.6 trillion a day, 47% of that is in the pound dollar, the euro dollar, and the Japanese yen dollar yen. Those three currencies form 47%. They used to just be 85% euro dollar and pound dollar. But because so many other countries are producing goods and services that they want to use to exchange with other countries, that's where the growth in the currency market itself has come from. And the reason that the shrinkage between those two currencies, euro dollar and pound dollar, have now been reduced from 85% to 47%. And the dollar yen has come into the picture of those three. That's 47%. That's a huge distributed market outside of those currencies. Now, granted, the major six pairs are probably 85% of the full currency market, but that's okay. The purpose of the market is what we're talking about, and that purpose is for countries to exchange goods and services through the changing up of their currency. The increase when I started looking at the currency market in 2007, it was $3.4 trillion away. So we jumped from 2007 to 2026, and it's $7.6 trillion. That growth has indicated far more purpose to the currency market than has ever existed before. And it makes it tremendously legitimate. It's a legitimate reason why the UK would be selling pounds to buy dollars, because we know what they're doing with them. They're not buying drugs. They're buying engine parts, okay? So it's a legit market. You see so many of these people that have traded Forex. Forex is a scam. That's the most absurd, stupid. If anybody ever says that, just run from them, because they have no idea and they have no concept of finance or business or anything. Those are the guys that Forex is a scam, and they went and they did crypto. So when you're looking at the Forex market, the purpose of that market is solid, it's reasonable, it's legitimate, and it's necessary. That's number one. Number two, we just got done with purpose. The second one is liquidity. Because it's $7.6 trillion a day, that dwarfs all of the stock markets combined. And so that means there's a whole lot of people using it, there's a whole lot of money sloshing around, and it's available bid ask at any price. It's liquid. You're very rarely going to find a gap. You might find a gap on the 1 minute chart or the 5 minute chart or something like that when somebody comes in with $4 trillion order and just tries to push his way around. Sure. But so what? That gap fills itself on the 5 minute chart. That gap fills itself on the 15 minute chart. You just can't, it's not like Bob's, 92 store oil company delivery business, and they're on the market, and somebody comes in, and the float on the day will be 5 million shares or something, and some guy comes in and buys 2 million of the shares, and you gap it and push it around. It's not like a commodity where there's a huge rainstorm that wipes out the corn crop, and so corn just goes crazy in price. And there's gaps in those prices. Now you get caught on the wrong side of a limit move, a lock limit move, and man, you're screwed. You lose your house. Not just the $40,000 that you put in. You lose your house. You lose everything. So the liquidity plays a tremendous reason for the best market to trade criteria, because you can always have your order filled. Now, if you're trading cross pairs or you're trading exotics, good luck to you. The ATR on a 5 minute might be running 20 or 30 pips. Your spreads are 10 or 12 pips. Good luck. Okay? I'm only talking about, and I only would suggest that you trade the 6 major currency pairs. Today, all of those pairs have got a USD component. If you don't like the United States, sell the dollar then. Just you'll find pairs that you could sell the dollar and be successful at. But that's just the way it is. We're the world's largest economy right now, and so therefore we're the dog. We won't be the dog for long, because you have all these wonderful countries coming up with products and services and innovations. Whether that's going to be China or Russia or Japan or Thailand, I mean, you don't know. But right now, when you're going to sit down at the table, you better be sitting down at the major 6 pair table in order to get the 85% of the liquidity within that market availability of $7.6 trillion a day. It's critical that you understand the advantages of liquidity. If this hasn't been a good enough discussion, then go look it up, because it is really, really important, okay? And now let's talk about the safety of the Forex market. We've covered purpose, we've covered liquidity, and now the safety aspect of it. If you're going to be driving a car, how safe is this car? You go to Consumer Reports when they have a car issue, and they say, well, stabilizing bars and this and that and the other thing, and the electrical systems are safe, and you want to drive a safe car. You want to be in a safe house where the electrical system has been moved up to code. You want to be sure that the airplane that you're going to travel in is going to be safe. Safety is at the forefront of our minds when doing anything. But you're not concerned about the safety unless the purpose and the liquidity of the Forex market is there. Now, what makes it safe? It's safe because of the purpose, and it's safe because of the liquidity, and it's safe because of the way that we're able to trade that market. If you're playing craps in the casino, pass line craps is your least dangerous game to play in the casino. It's 1.14% against you, something like that. Play roulette, it's 36 to 1 against you. So you take your choices. So if you're looking for safety in the casino, you're still in a negative safety risk of ruin. In the currency market, you don't have a risk of ruin as long as you have good risk management. Can you have risk to ruin in the currency market? Yes, you can. But because of the basically unlimited upside potential, you have instantaneous ruin if you get it wrong and you hold on to your position. And that's where the liquidity comes in. When you decide your pain point has been reached and you hit I'm out, you're out because the liquidity is there to provide that. Again, if you're trading a cross pair or an exotic, that price is moving so fast, you hit the out button, and by the time it takes that order to get through, you've lost 30, 40 pips in a panic. So that's not safe. I'm talking about the major pairs. You can enter those pairs, and you can pull your money off the table at any time. If you put your money on the table, you can't pull it off. It's on the table until you lose or until you win. It's as simple as that. In the currency market, it's safe because you're in control of your trade. If you want to let it ride, you want to carry it over, you can float a stop behind it. If you don't want to float a stop and you just want to let it go and risk 50% of your account in order to make 400% on your money in a few months, that's fine. You're in the decision point. So if you lose, it's your fault, not the market. Because the purpose of the market is clear. The liquidity is there to protect you, and it's safe if you get the proper training. And you don't try to make this shit up on your own. Oh, I'm going to use a Bollinger Band with an RSI and a Golden Cross. Really? If that shit worked, then why is the failure rate of the retail trading currency market 90%? 90% of the retail traders lose 90% of their money in 90 days. That was a statistic that a large and very prominent retail FOREX broker many, many years ago surveyed 25,000 of their clients, 43 million transactions, and those statistics have held up to today. 90% of the retail traders lose 90% of their money in 90 days. Why is that? Is it because you got all these stupid people going in? No, it's because you don't have the right education, you have the right training, or you don't want that, and you're gambling. If you're gambling, you're going to lose in the Forex market for sure. You want to gamble, do penny stocks. Your odds are a lot better. But if you want to trade, which is totally different than gambling, you're assuming risk, you're not taking risk. And it's your risk management that provides you the ability to know how to assume that risk properly based on the characteristics of the market, the day of the week, the currency pair that you're trading, the size of the bank that you're trading, and who you are as a person. That's all involved in developing your risk management plan, in your overall trading plan. If you don't have somebody that's working with you, that's showing you this stuff, and they're just saying, oh, you're going to use a Bollinger Band, and this is what you do then, and then if price does this, then you get out. No, that's not the way it goes. I was a software engineer for 33 years. I know how to solve complex problems. And that's where my life cycle of a currency position came from. The life cycle of a currency position is just a rip against the software development life cycle, the SDLC, which is a complex process for solving really complex problems. I just took a rip on that and created the life cycle of a currency position, which has 3 phases, which means it has 3 problems to solve in the life cycle of a currency position: entry analysis, position management, and exit methodology. And those are 3 still complicated problems to solve. And yet that complexity can be reduced to 1 rule. And each rule has between 2 and 4 conditions that have to be met before the rule can be executed. So I just made it simple. Software engineering is a really difficult thing. If you just sit down and somebody says, hey, we got this problem with our warehouse system, boxes that are supposed to go to Illinois are going to Zimbabwe, and we're sending the wrong products and the wrong invoices. You got to fix the programming in order to do this. How do you do that? You've got to break that down into small, easily manageable chunks. You've got to solve that problem. Then you've got to figure out how that solution is going to talk to the next solution. In other words, the communication between those problems. And that's why in the life cycle of a currency position, you don't start with position management. You start with entry analysis. If you've got a bad entry, you don't have any position to manage and you don't have any exit methodology. You got pooped out. So everything is sequential. So I have 3 rules, but they're sequential. So there's no permutation. There's only one road there. It's entry analysis, position management, and exit methodology. I mean, if you'd like to know more about that, this isn't a video for that. Send me an email. I'd be happy to chat with you over email or even a video conference if you want to help you understand that at no charge. I'm not selling my fast track course. It's a 6-week course. If you're interested in talking to me about that, fine, we can talk about that. But I'm not selling courses. I'm willing to help you out. So if you don't understand what I'm talking about, the life cycle of a currency position, which makes the currency trading safe. The currency trading is safe to start with because the component pieces that are available to us to trade without the life cycle of a currency position allow that trading process to be safe. But if you don't know the order to put the things in and you don't know what I call relevant information, which is a big thing that we talk about in the fast track course, what's the relevant information? You know Bollinger Bands, and you know this, and you know limit moves, and you know RSI, and you know what the Swissy is, and you know all this information. But there's only about 30 pieces of information that I call relevant information. Most computer programming languages only have 20 to 30 major commands. If you learn those 30 things, then you can program. Just like in music, you know, you've got 8 notes. So look at the complexity that evolves out of those 8 things. When you're looking at the life cycle of a currency position, you're not looking at complexity, you're looking at simplicity, because the product of the entry analysis phase of the life cycle of a currency position forms the base and communicates to the position management phase of the life cycle of a currency position, which then communicates with the exit methodology section of that process of your trade as it moves through as a position, as it moves through the position, the price action that you're going through. So you can have safe, which is I'm not gonna do currency trading at all, which is 100% safe, to just looking at using stops or not using Fibonacci numbers and not looking at Bollinger Bands and all that other shit, but just looking at the currency market and trading the price action and seeing what to do. You can be safe that way. You have to take that information though and create a solid risk management process for yourself. You can't just wing it and say, oh, I know all this shit and I'm going to go in and I'm going to do it, because you'll be solving problems in real time, which are taking your attention away from the real problems that you need to solve. Anybody that's talking about risk management during the position management stage is crazy. They're just you don't need to do that. You solve that up front, so you never have to worry about it. That's your risk management. You can't be doing risk management in real time. That's my position. That's what I do. I don't know what everybody else does. But chances are you're being taught risk management as a concern all the way through the time that you hold that trade. Okay, good luck. Is Forex the best market to trade? Yes, it is. And that is because the opportunity, first of all, is there. If there's no opportunity, then you don't need to worry about the rest of these things. You just don't do it. So the opportunity is there. And the opportunity is there because of the Forex market's purpose, because of its liquidity and because of its safety. If you'd like a little bit more information on this, feel free to send me an email. I'd be happy to chat with you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.